Welcome to the Deep Dive, where we plunge headfirst into complex topics, cutting through the noise to bring you the clearest, most crucial insights. Today, we're dissecting a question that could fundamentally reshape the global financial landscape. Could the next iteration of one of the world's most powerful currencies, the euro, soon be running on the very same public blockchains that power your favorite crypto projects like Ethereum or Solana? That's right, the European Union isn't just flirting with the idea, they are seriously considering a monumental shift.
It's an incredibly significant development, truly. For years, the concept of a central bank digital currency, or CBDC, from a major economic bloc like the EU felt like something for the distant future, often confined to internal private discussions. But what's genuinely groundbreaking now is this explicit and serious exploration of public blockchain infrastructure for the digital euro.
Right, public chains.
Exactly. This isn't a minor tweak. It's a profound departure from the more traditional, restricted, and, well, private systems that many might have initially expected.
And it sets the stage for today's deep dive. Our mission is to unravel the pressing reasons why the EU is making this pivotal reassessment. We also want to dissect the profound trade-offs between strategic autonomy and the deeply rooted European value of individual privacy. And ultimately, to peer into how this monumental decision could reshape the future of finance, the burgeoning crypto ecosystem, and even the way you manage your own digital assets. We've dug into insights from the Financial Times, Cointelegraph, CryptoSlate, Axios, and more to bring you the essential nuggets of knowledge you need, not just to be informed, but truly well-versed in this evolving story.
Yeah, and if you've ever found yourself wondering how global finance is quietly but rapidly evolving, or maybe how close we are to seeing major national currencies interact directly with the world of decentralized finance, then this deep dive is absolutely for you. This is a critical moment in monetary history, honestly. Understanding the nuances, the drivers, and the potential consequences is really key to grasping what's next.
So let's unpack this. What's truly ignited this pivot? For years, the digital euro was an evolving concept, moving along steadily. But a recent shift in the global financial landscape, particularly across the Atlantic, seems to have injected a powerful new sense of urgency.
That's right.
We're talking about the driving forces pushing the EU to rethink the very infrastructure of its digital euro, and why now seems to be the moment of truth.
What's fascinating here is that the EU is no longer approaching this project with, let's say, leisurely academic deliberation. There's a palpable sense of urgency, almost a strategic imperative. The European Union is significantly accelerating its digital euro project, and a major, undeniable catalyst for this has been legislative developments across the Atlantic, specifically the recent U.S. Genius Act.
The Genius Act. Okay, this isn't just some obscure congressional bill, right? It's a law that actively and purposefully promotes dollar-backed stablecoins. So for our listeners, how does this U.S. push to dominate digital payments through these stablecoins create such immense pressure on the euro? And why does this quickly escalate into a core concern about the EU's financial sovereignty?
It creates immense structural pressure, absolutely. And it truly boils down to the very essence of financial sovereignty and strategic autonomy. The Genius Act isn't merely promotional. It aims to establish a clear, comprehensive federal regulatory framework for stablecoins in the U.S.
Okay, so providing clarity.
Exactly. This framework offers legal certainty and robust consumer protections to issuers and users of dollar-backed stablecoins. This clarity and regulatory robustness are a strategic advantage, making these digital dollars a far more attractive, less risky option for global businesses and investors.
Right, less risk, more attractive.
Think about it. If global digital transactions, from cross-border trade to international remittances, are predominantly settled in these dollar-backed stablecoins, regardless of where those transactions originate, what does that mean for the euro's economic and political standing on the world stage?
Yeah, marginalizes it.
Precisely. A weakening foothold in digital payments isn't just a minor economic inconvenience, it becomes a strategic national security concern for the EU. Sources like CryptoSlate and A-Invest consistently highlight this concern that the EU needs to act decisively and swiftly to maintain its monetary influence and prevent a digital dollar hegemony.
So, painting a picture here. If the EU doesn't act effectively, if the digital payment landscape becomes overwhelmingly dominated by non-euro currencies, what are the cascading long-term consequences for European businesses, for everyday consumers, and perhaps most critically, for the EU's geopolitical influence?
The implications are, frankly, profound and far-reaching. If the EU does not act effectively to establish its own digital currency, European businesses, particularly those engaged in cross-border trade, could find themselves increasingly reliant on foreign-denominated digital currencies for settlement.
Hmm.
Consider a European manufacturer whose supply chain spans multiple continents. If payments in this chain are predominantly settled in digital dollars, that manufacturer faces constant exposure to USD-EUR exchange rate fluctuations, potentially higher conversion fees, and less transparency into the underlying payment rails if they're outside European oversight.
Which means more cost, less competitiveness.
Exactly. It translates directly into increased operational costs, reduced competitiveness, and a diminished ability to hedge against currency risks. For consumers, imagine a future where purchasing digital goods, subscribing to global services, or even making larger online payments almost always defaults to a dollar-backed stablecoin.
Yeah, extra steps, extra fees maybe.
Not only does it add friction through currency conversion, but it also diminishes the euro's presence and relevance in their everyday digital lives. Over time, this erosion of the euro's digital relevance would translate into less influence on global financial standards, weakening the EU's voice in international economic forums, and potentially accelerating a shift away from the euro as a global reserve currency. This isn't merely an economic calculation, it's a strategic imperative to ensure the euro's enduring influence.
A core sovereignty issue.
Absolutely a core tenet of EU sovereignty.
Okay, this brings us to what many are calling the most surprising, maybe even revolutionary aspect of this whole discussion, the EU's serious consideration of public blockchains, specifically mentioning Ethereum and Solana as potential infrastructure for the digital euro. This signals a monumental shift because previous conversations often focused exclusively on more restricted private systems.
It absolutely is a pivotal transition in EU policy, as noted by outlets like Axios and Cointelegraph. To truly grasp why this is such a seismic shift, particularly for a central bank, we need to clarify the fundamental difference between public and private blockchains in this context. I mean, for those already tracking the blockchain space, the distinction between a public or permissionless chain and a private or permissioned chain is well established.
Right, the basics.
A private system typically involves a limited, controlled group of participants, like a consortium of banks or a central bank with its approved intermediaries. It's essentially a walled garden designed for control and privacy within that limited group.
Controlled environment. And the leap to a public system, like Ethereum or Solana, what does that really signify?
A public system, like Ethereum or Solana, is fundamentally open. Anyone can view transactions, anyone can participate in validating, anyone can build on top of it. The fascinating part here isn't just the technical difference, it's the profound policy pivot by the EU, an institution historically inclined towards controlled, private environments, to even consider a public, permissionless infrastructure for its sovereign currency.
It's a huge change in thinking.
It signals a remarkable openness by central banks to emergent technologies that were, for a long time, viewed with skepticism, often dismissed as too volatile, too unregulated, or too difficult to control. The fact that the EU is even considering this shows a significant evolution in their thinking regarding innovation, decentralization, and, frankly, global reach.
Okay, to give us some really illuminating context here, let's look east. China's ECNY, their digital yuan, that's been widely described as a closed model. How does that approach starkly contrast with what the EU is now, well, audaciously exploring?
It's a perfect, almost textbook example of these divergent CBDC philosophies globally. It really highlights the ideological crossroads many nations face. China's ECNY is a fully private, government-controlled digital currency. In this closed model, the central bank has complete oversight and granular control over all transactions and user data.
Complete control.
What does this mean in practice? For citizen privacy, it generally means less. The government can potentially monitor all financial activity, track spending patterns, and even program money with expiry dates or specific use cases, offering a high degree of control over the economy and its citizens' financial lives.
Programmable control, but maybe not the kind users want.
Exactly. And for global interoperability, it tends to be less open. It's designed primarily for domestic use and controlled integration points rather than seamless global adoption. It fundamentally prioritizes central control, domestic stability, and state surveillance over open innovation and widespread global integration.
Whereas the EU, by even looking at public chains,
The EU, by even considering public chains, is signaling a very different path. One that, while complex, fundamentally emphasizes global interoperability and innovative programmability. albeit with significant challenges, especially around its core values like privacy.
And that takes us directly into the heart of the matter, the grand trade-off. Because this consideration of public chains, while incredibly exciting and forward-thinking, isn't without its formidable challenges,
Yay.
particularly when it comes to balancing that innovation with fundamental European values like privacy and strategic autonomy.
Exactly. This is truly where the rubber meets the road, where theoretical advantages collide with practical, ethical, and political realities. On one side, we have the immense allure of programmability and seamless DeFi integration.
Yeah, the potential upside.
A public ledger offers unmatched potential for dynamic programmability and unparalleled potential for integration with existing decentralized finance, or DeFi, ecosystems. The overarching strategic goal here seems to be maximizing global interoperability, utility, and the euro's digital reach.
So let's dive deeper into programmability for a currency. When we talk about smart contracts, how might this fundamentally transform the digital euro, taking it from just a simple medium of exchange into, well, a dynamic platform for entirely new financial instruments and automated economic processes?
It's a complete game changer, potentially. It truly unlocks a new dimension for a currency. Imagine a smart contract that automatically releases payment for goods or services only once predefined conditions are met.
Like delivery confirmation.
Exactly. Like a product being delivered and verified by an IoT sensor, or a project milestone being independently confirmed by an oracle. This removes the need for costly, time-consuming intermediaries and reduces counterparty risk significantly.
And lining things.
Or consider conditional transfers, where funds are released only when specific criteria are satisfied. This could revolutionize everything from aid distribution to escrow services. Beyond that, new types of financial products, think tokenized bonds with automated coupon payments, automated lending protocols that disperse credit based on preset conditions,
Automated finance, basically.
or even dynamic taxation mechanisms, could be built directly on top of a digital euro running on a public chain. This broadens the potential utility of a digital euro far beyond traditional banking systems, truly entering the realm of a programmable, intelligent digital economy. Sources like Cointelegraph and CryptoSlate really highlight this potential.
And this concept of global interoperability, how does integrating with DeFi really help achieve that? And what could that mean for the EU's global economic standing?
Well, global interoperability entails the ease with which the digital euro could be used across different platforms, countries, and financial services, without needing complex conversions, multiple intermediaries, or bespoke integrations. By integrating with existing robust public blockchain ecosystems like Ethereum and Solana, the digital euro could immediately tap into a vast global network.
Leverage the existing infrastructure.
Exactly. A network of developers, existing decentralized applications, and millions of users worldwide. This fosters a more frictionless, borderless global payment system and allows for innovative financial services to emerge quickly and organically.
And strategically for the EU.
From a strategic perspective, this could attract global capital and talent directly to the EU's digital economy, making it a hub for Web3 innovation built on a sovereign currency. Imagine a European business being able to receive payments in digital euros directly into a DeFi protocol for yield generation.
Seamless integration.
Or a consumer making cross-border payments to a vendor in another continent with minimal friction and at a fraction of the cost, using a central bank-backed digital currency. This isn't just about efficiency, it's about cementing the euro's relevance in a rapidly digitizing global economy.
That potential for innovation and global reach sounds incredibly powerful. But then there's the other side of that coin, and it's a formidable one. The privacy and data exposure dilemma.
This is precisely where the grand trade-off becomes most significant, and it's a concern ECB officials are meticulously weighing. While public ledgers offer immense advantages in terms of programmability and interoperability, they also raise considerable privacy and data exposure concerns that directly challenge deeply held European values.
So why do public blockchains present such unique and complex privacy challenges compared to, say, a traditional banking system or even a private CBDC like China's? And specifically, how does this conflict with Europe's stringent data protection values, like those enshrined in GDPR?
The core issue is that every single transaction on a public ledger is immutably recorded, and in many cases publicly viewable, even if pseudonymously. While you might not see John Smith paid Jane Doe €50, you see a string of alphanumeric characters representing an address paying another address.
Anonymous, not anonymous.
Exactly. And with sophisticated blockchain analytics, even pseudonymized data can potentially be de-anonymized over time, or at least linked to real-world identities through various on-ramps and off-ramps or patterns of behavior.
Which clashes with GDPR.
This transparent public record can conflict quite directly with European values around data protection and individual privacy, which are enshrined in regulations like GDPR. GDPR emphasizes data minimization, purpose limitation, and the right to privacy by design. The kind of data exposure officials are worried about includes granular spending patterns, financial habits that could reveal personal interests, political associations, or health information, and the potential for surveillance, whether intended by the government or exploited by third parties. Sources like Binance and A-Invest really emphasize these concerns.
The potential for profiling.
Imagine the kind of financial profiling possible if every digital euro transaction, however small, was visible and potentially analyzable on a public ledger.
So this is a core question they're grappling with. How might the EU attempt to mitigate these privacy risks while still leveraging the benefits of public chains? Are there specific technological solutions, or does it require a more fundamental shift in public expectations around financial privacy?
It absolutely is a core question, probably the core question, and one that will define the digital euro's eventual form. Technologically, solutions like zero-knowledge proofs or ZKPs or layered privacy solutions could be employed.
ZKPs, right?
For instance, ZKPs allow you to prove something is true without revealing the underlying data. Imagine proving to a bouncer you're old enough to enter a club, but instead of showing your ID with your exact birth date, you simply offer a cryptographic proof that verifies your age without revealing any other personal information.
Verifying without revealing.
That's the essence. You could confirm a transaction's validity, say, that you have enough funds without exposing the exact amount, your identity, or the recipient's identity to the public ledger. Layered solutions might also involve keeping some transaction details off-chain or aggregating financial data in privacy-preserving ways on a secondary, perhaps permissioned layer that interacts with the public chain for final settlement.
Interesting. Hybrid approaches.
Possibly. However, there's also the possibility that it requires a more fundamental shift in public expectations. If a central bank-issued digital currency on a public chain offers unprecedented utility, interoperability, and perhaps even built-in protections against financial crime, citizens might accept a different privacy paradigm, especially if robust safeguards and clear legal frameworks are explicitly built in. It's a very complex balance.
Harnessing innovation without eroding rights.
Exactly. Trying to harness innovation without eroding fundamental rights that are cornerstones of European society.
Okay, shifting gears slightly, let's talk about the ripple effect. And it's still an if, but if the digital euro were to launch on Ethereum or Solana, what kind of immediate and long-term impact would that have on the broader crypto and Web3 ecosystems, particularly for these specific networks?
This is where the excitement really builds for anyone tracking the crypto space. Should the digital euro, a currency for over 340 million people and, 15 trillion economy, should that launch on either Ethereum or Solana, it would massively boost utility, liquidity, and transaction volume on those specific networks in an unprecedented way.
I can only imagine the scale of that. What would be the direct, tangible benefits for those specific blockchains? Beyond just more activity, how would it fundamentally strengthen them?
The direct benefits would be truly enormous and multifaceted. Increased transactions mean significantly higher network activity, which could lead to increased fees for the network's validators and a stronger fundamental demand for their native tokens, ETH or SOL, respectively.
Driving demand for the native tokens.
Absolutely. More importantly, it would profoundly enhance the security and decentralization of these networks by attracting more validators, increasing the economic stake in their integrity, and drawing in a wider, more diverse user base.
Okay, let's think about that network impact model idea. If even a fraction of Eurozone payments moved onto these chains.
Right. If even a conservative fraction of the Eurozone's daily payment volume, which currently sees trillions of euros changing hands daily through various channels, If even a small piece of that were to flow through one of these chains, the potential ETH or SOL fee inflows would be substantial. We could be talking millions, maybe even billions annually.
Wow.
This would not only strengthen the economic model of the underlying blockchain, but also solidify their positions as foundational layers of the global digital economy. It would attract further innovation and investment. This isn't just a boost. It's a legitimization and a massive injection of real-world utility.
And it wouldn't just be about boosting the networks themselves, right? Such a move would also create immense on-ramp opportunities, fundamentally deepening the integration between traditional finance and the decentralized world of DeFi.
Precisely. This would significantly boost on-ramp opportunities for the digital euro directly into existing crypto wallets and decentralized finance protocols. To clarify, on-ramp here means making it dramatically easier and more direct for users to convert their traditional euros into their digital euro equivalent within the crypto ecosystem.
Bypassing intermediaries sometimes.
Potentially bypassing traditional banking intermediaries for certain functions, particularly for high-frequency or microtransactions. This would foster a deeper, more seamless, and more capital-efficient integration between traditional finance and DeFi. It would break down barriers and reduce friction in a way we've only theorized about until recently.
And we're already seeing compelling evidence of this trend, aren't we? Even without a full digital euro, European banking groups are already making moves that sort of mirror this trajectory.
Absolutely. While U.S. dollar-backed stablecoins currently dominate the market with a staggering, 98% share globally, European banking groups are not sitting idle. They are actively preparing for this future. We're already seeing leading institutions like Société Générale
Not a French bank, yeah.
launching MiCA-compliant euro stablecoins on Ethereum and Solana. And for our listeners, MiCA-compliant means they adhere to the EU's landmark markets in crypto assets regulation, which establishes a comprehensive and harmonized legal framework for digital assets across the entire EU.
So regulation is enabling this already.
Yes, and this action by Société Générale is a crucial mirroring of the EU's potential digital euro trajectory. It demonstrates that there's already significant institutional comfort, robust regulatory frameworks being established, and a clear established path for euro-denominated digital assets to exist and operate on these public blockchains. It's not just theoretical, it's happening, paving the way for a central bank-issued version.
So for you, the listener, imagine being able to use a central bank-issued digital currency, the digital euro, directly in a DeFi lending protocol to earn yield, or seamlessly for a blockchain-based payment to a merchant halfway across the world. This really could fundamentally change how you interact with money daily, making it more flexible, programmable, and globally accessible.
It truly could. It removes layers of intermediaries, reduces transaction costs, and could make financial services more accessible, efficient, and innovative for everyday users and businesses alike. This is where the vision of a truly integrated, programmable, and globally accessible digital economy starts to come into vivid focus, with a sovereign currency at its core.
Beyond the immediate technical and financial aspects, a digital euro on a public blockchain would have massive cascading implications for the global regulatory landscape. It would signal an unprecedented level of institutional trust in these technologies, wouldn't it?
This is a point of immense, almost foundational importance. It's about legitimization and setting a global precedent. If the EU, a major global economic power with a strong regulatory tradition, formally adopts a public blockchain for its central bank digital currency, what message does that send to other central banks, governments, and regulatory bodies worldwide?
A huge green light, essentially.
It would represent an undeniable high-level endorsement, moving beyond the perception of crypto as purely speculative, illicit, or niche. This could accelerate the development of clearer, more favorable, and more harmonized regulatory frameworks for the broader crypto space globally, shifting the narrative from caution to strategic innovation.
Could this be the catalyst for a global race to innovate in the CBDC space, with other nations feeling compelled to explore similar public chain models? And critically, how might this affect the current overwhelming dominance of dollar-pegged stablecoins?
It very well could be the trigger for a new phase in the global digital currency race. If the EU successfully demonstrates that a public blockchain-based CBDC is not only viable, but also offers tangible benefits in terms of innovation, interoperability, and strategic autonomy, other nations might feel a strong impetus to follow suit to avoid being technologically or economically left behind.
Keeping up with the EU.
Exactly. This could dramatically shift the EU versus US stablecoin landscape we know today. We could see a diversification of global digital currency options beyond current dollar-pegged dominance. Other central banks might, for example, explore issuing their own CBDCs on similar public infrastructure, or encourage their domestic financial institutions to launch their own fiat-backed stablecoins.
More competition, more innovation.
Exactly. This would lead to greater competition, more innovation, and potentially more choices for users worldwide, challenging the existing hegemony and redistributing digital financial influence. It's not just about the euro, it's about the future of global digital money and who controls its infrastructure.
That's a truly fascinating and potentially disruptive future. Now let's talk about some real-world precedents and what the road ahead looks like for this incredibly ambitious project. Because as you've hinted, we're not starting from absolute zero here.
It's crucial to understand that this isn't entirely theoretical or an untested leap into the unknown. Solana, for instance, already has significant demonstrable institutional integration. Major global banks like HSBC and Bank of America are already integrating with the Solana network through R3's infrastructure deal.
Okay, R3. Can you elaborate on the significance of R3 in this context for our listeners who want to be intimately familiar with them? And what exactly does this infrastructure deal with Solana entail? How does it work?
Absolutely. R3 is a consortium and an enterprise blockchain software firm. They specialize in building distributed ledger technology solutions specifically designed for traditional financial institutions. Their flagship product, Corda, is widely used for things like interbank settlements and tokenized assets within the traditional finance world.
So they bridge the gap.
Precisely. The infrastructure deal with Solana isn't just a handshake. It essentially provides a standardized, secure on-ramp or integration layer. This enables major banks, using R3's enterprise-grade tools, to connect their existing, often legacy, financial systems directly to Solana's high-throughput public network.
Okay, connecting old and new.
It allows them to experiment with tokenized assets, interbank settlements, or even potentially future digital currency rails within a familiar, compliance-focused enterprise environment. The fact that established financial giants like HSBC and Bank of America are using R3 to connect with Solana via this partnership provides a clear existing pathway for potential CBDC deployment.
A proven pathway.
It's not just a hopeful theory, it's a demonstrable financial ladder up for Solana into traditional finance. As noted by sources like the Financial Times and Bitcoin News, it signals a growing comfort, a proven technological capability, and a practical integration of these public chains within established banking systems.
So this means the infrastructure and, importantly, the comfort level for using public blockchains within established banking systems are already growing. It makes the EU's consideration less of a radical leap into the unknown and more of a logical, albeit still very strategic, progression. This significantly de-risks the proposition, perhaps.
Exactly. The EU isn't pioneering a completely untested integration. They're observing existing models, existing partnerships, and existing pathways for this kind of institutional adoption, which provides a crucial foundation of confidence and practical experience. It helps them build on existing innovations rather than starting entirely from scratch.
Okay, this is all incredibly dynamic and fast-moving, but what's the current timeline? When are these critical decisions expected to be made regarding the digital euro's infrastructure and design? And what should we and our listeners be watching for?
The Digital Euro project remains very much in active development, navigating complex technical, legal, and political landscapes. Critical decisions regarding its precise infrastructure, public, private, hybrid, and overall design are expected to be finalized by the end of 2025.
End of 2025. That's coming up relatively quickly.
It is. This decision point is absolutely pivotal because it marks the culmination of extensive research and policy development. The EU's policy is clearly undergoing a significant transition toward exploring open blockchain infrastructure, moving from investigation into a more defined preparation phase.
So what are the key stages or milestones we should be looking out for between now and the end of 2025? And remind us, who are the key players, the decision makers guiding this monumental project?
Well, we've evolved from an initial investigation phase, which assessed feasibility and potential use cases, maybe around 2021, 2023. Now we're firmly in a preparation phase that includes detailed experimentation with different technologies, particularly exploring the types of blockchain infrastructure we're discussing today. The EU CBDC timeline really reflects this shift.
From theory to practice.
Exactly. Towards concrete technical exploration and policy formulation. The key players are primarily the European Central Bank, the ECB. They've been driving the technical research, policy considerations, and practical experimentation. And alongside them, the European Commission, which is responsible for the legislative framework that would govern a digital euro,
The rules of the road.
addressing legal tender status, privacy rules, anti-money laundering aspects, and other crucial legal points. We should expect continued research publications, results from various pilot programs and technical experiments, and detailed policy proposals to emerge as we approach that 2025 deadline.
What should we watch for specifically?
Any public consultations, statements from ECB President Christine Lagarde, or legislative drafts from the Commission will be critical indicators of their direction. Pay attention to those.
Okay, so this isn't some distant theoretical future we're talking about. These are strategic, foundational decisions being made now. And they will directly impact the financial landscape for decades to come, not just for Europeans, but potentially setting a global precedent.
Precisely. The outcome will shape not only how Europeans interact with money, trade, and financial services, but potentially set a precedent for other nations and profoundly influence the global balance of financial power in the digital age. It's a truly captivating and consequential moment to be watching.
What an absolutely fascinating deep dive. We've explored the urgent forces driving the EU's digital euro project, particularly those strategic pressures from the U.S. Genius Act. We've dissected the revolutionary shift towards seriously considering public blockchains like Ethereum and Solana, moving away from, the traditional private systems. And crucially, we've weighed the critical balance between the allure of innovation and global interoperability against the very real concerns about privacy and data exposure. This isn't just about a new digital currency. It really feels like it's about the fundamental architecture of money itself and how it will function in our increasingly digital world.
It really is. And it raises a profound question for all of us, for you listening. Given the incredible potential for innovation and global interoperability that a public blockchain-powered digital euro could offer, balanced against the very real, deeply felt concerns about privacy and potential data exposure, would you trust a digital euro running on a public blockchain?
That's the key question.
Or do you believe the compromise on privacy is simply too great for a central bank-issued currency? This is the core dilemma the EU is grappling with right now, and one that all citizens, businesses, and policymakers should thoughtfully consider. Is public blockchain the inevitable future of money, or is privacy too big a compromise for a CBDC?
It's a heavy question, absolutely, and one without an easy answer. It touches on both technological possibility and fundamental values. If you found this deep dive into the digital euro as fascinating and thought-provoking as we have, and you want to stay at the forefront of these critical financial innovations, please take just a moment to engage with us. Liking this video, leaving a comment with your thoughts on the digital euro, and subscribing to our channel truly helps us out.
It really does.
Your support boosts our visibility in the algorithm, helps more curious learners find these crucial discussions, and allows us to keep bringing you quality content like this, exploring the evolving world of crypto, DeFi, and central bank innovation. We love hearing your perspectives, so let us know in the comments. Which chain do you think would be best suited for a digital euro? Ethereum for its massive ecosystem, or maybe Solana for its speed and growing institutional readiness? Or something else entirely?
Yeah, your engagement really does make a tangible difference, and it directly helps us continue to unpack these complex, critical topics for you. We appreciate you joining us on this deep dive, and we genuinely look forward to hearing your insights in the comments.